Good morning. Marc Ostwald from ADM ISI with some thoughts on this week's central bank events. The week kicked off with the ECB giving us some fairly strong signals that if things don't improve, then they will act as appropriate, which is sort of the same message as we're getting from the Federal Reserve. But the primary point of focus obviously was the US Federal Reserve. As my first table shows, we are now fully pricing in a rate cut in July. In fact, we are pricing in a 22% probability that it might not just be 25 basis points, but actually 50 basis points. That's probably fueled by the fact that Mr. Powell at the press conference suggested that given when rates are as close as they are to the so-called lower bound on rates, then it's better to perhaps behave more aggressively. Eminently, one of the reasons why the Fed didn't cut at the current meeting is it's still hoping that there might be some positive outcomes from the G20 meeting, which obviously happens at the end of next week. There are slightly more positive sounds from there, but it's not necessarily really the case that we are expecting anything. So we have basically got 100 basis points of rate cuts priced in by March of next year, which is a pretty aggressive trajectory, one would have to say. And I think it's worthwhile in that context having a look at the next table, which is the Fed's own projections. If you just looked at those projections, you wouldn't have expected the sort of message that they gave us. They've revised up their GDP forecast for 2020 very marginally. They have revised down the projection for headline PCE inflation this year to 1.5, which is well below the target of 2%, but it's still seen back at target roughly over the next 2 years. And indeed, core inflation also only seen down, revised down very slightly. So those projections really wouldn't have made one expect them not to lean against the markets, what the market's discounting in the way of rate cuts. And indeed, if you actually have a look at the Fed's projections, yes, they did cut them, but they're basically assuming that where we are currently on rates we'll be back at in 2021, and we won't be down at the 1.5% that the market's discounting. So well worth bearing in mind, I think, because the lack of a rate, any move by Mr. Powell to lean against the market expectations, I think is quite significant, and it does actually suggest that as much as they probably will deliver on a cut in July, the bottom end of where they end up may be somewhere different, particularly if we start to see things improve with the global economy. So how about the market reaction? Well, if we have a look at the next table, what one can see is we've now got US 10-year yields down at 2%. We've got record lows in both Japan, unbelievably. Japanese government bond market, the great widowmaker trade of the past 25 years in terms of anyone who's sold it has always ended up on the wrong side of that. Germany now at minus 0.3%, and a good deal of others, even the likes of Italy, with all the concerns there are about the budget, still very, very low in terms of actual yields, even if the spread is obviously wide. So all of those very, very low yields obviously prompts a bit of a dash for trash. So I've brought in two charts, apart from obviously the equity market going on a roll yesterday particularly. If we have a look at the next two charts, what one can see is the Fed's move also sparked a very sharp move in high yield credit in the US. We basically lopped off 30 basis points off that spread. We are towards the lows of the last 9 months. We're not quite at the lows that we got to last year. But it really is sort of, it raises one very big question on all of this, as does the next chart, which is of the emerging market bond spreads. That one's somewhat more cautious, even though the dollar is obviously weakening. But it does raise a big question, because if the Fed's message basically is that the global economy is starting to blow a lot of headwinds into the US economy, then will we, as we are gradually approaching the earnings season, really want to be going into riskier assets when the outlook for the corporate sector, given the global economy, isn't exactly that great?